All right, everything looking good. Should be live. Let me know in the chat if I'm coming through loud and clear. Let's go ahead and get this party started. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is Wednesday, 8 p.m. Eastern Standard Time on April 6, 2022. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Let's go ahead and get right into it. So obviously had some big moves in the market these last couple of days. To tell you the truth, nothing unexpected. Appreciate that, brother. Thank you, Eli. I've been right on schedule, right on track. Basically everything we have been discussing, everything we have been anticipating, predicting, been playing out quite well. We had quite a few trade setups play out already. Made sure to stress over and over again the importance of taking profits, and how, obviously we were anticipating a bull market rally, bear market rally. The bear market rally has played out, and it looks like more likely than not, we're starting to violate some key levels, and it looks like we're done. So, which is expected because nothing changed on the macro, nothing changed in the global environment. We're still going to be tightening. The future still looks grim, as much as I hate to say it. There's a ton of headwinds. Valuations are still at ridiculous levels. We still have had the loosest monetary, fiscal and monetary policy in pretty much existence going on over the last couple of years. So, I mean, it would only make sense that we're just lagging behind that and that we have in fact topped out. And obviously we can look at some charts and we'll see exactly why we feel that way. We'll talk about some key levels in multiple different asset classes to keep an eye out for, areas of validation or invalidation, basically telling us that, our thesis is correct. Obviously, we had the Fed minutes come out today. That was sort of a big deal. We had Brain Dead talk yesterday. Lael Brain Dead, the what will be the vice chair of the Federal Reserve, came out. She is basically like the ultimate libtard, like full on. Everything should be free for everyone. We need to stop global warming, and just everything needs to be like peachy, and we should all just get free money from everything, and just total retard. And so she came out basically and was hawkish. So when a total retard that wants to give everyone everything away for free, that has been the ultimate dove forever, now all of a sudden is hawkish, that's going to scare the market some. And then on top of that, talking about how the inflation risks are, a serious threat to the future and all this crap, which is obviously true. It's super obvious. I mean, the Fed is way behind the curve. The Fed is way behind everything. I mean, they have literally proved that they are useless. But the fact of the matter is that they've been they've been trying to get inflation for years, and now here they have it. So it doesn't surprise me in the least bit that they're not like, oh my gosh, we need to stop this inflation in a hurry. Like, they're going to say that. They're like, oh no, this inflation is terrible. But really, this is exactly what they wanted. They've wanted it forever. So now they're just making up for lost ground. That's exactly what it is. So they're binging on inflation, at the cost of the American people, and realistically, not even the American people, the entire world. Because when the United States, when the US dollar, when it experiences inflation, whether it's supply chain, whether it's money printing, quote unquote, whatever it is, the fact of the matter is, it affects the entire world. And we've been talking about how I anticipate the dollar is going to keep getting stronger and stronger, and how that's not good for the world, especially not for like third world countries who are going to have to try to compete against a stronger dollar to buy limited goods such as food and energy. So we've been through all these things, and we're watching them play out in real time. We're seeing the dollar strengthen. We're seeing the four horsemen of the apocalypse all riding at the same time very, very clearly. We're seeing, essentially speculative assets crashing down off their highs. We're seeing some of the indexes stay a little bit stronger, but all this is taking place while we see those key things like the yield curve inversion. Now, everybody's looking at the yield curve inversion now. That's fine. That's great. It's good that people are waking up to it. The most important thing, though, is that the actual cross, the 210 cross, is super important. It's super important. But in all reality, the real indicator of when we go into recession is not when they cross to the upside. It's not when the 2 starts yielding more than the 10. It's when they cross back down after the period. And sometimes they'll cross up and down a couple times. They'll oscillate in a range. But when they cross back down, that is when we're really paying attention to it. But we know we're already at a resistance level on the yield curve, or on the 2 and 10, basically historically coming down for the last 40 years of declining, peaks. And we know if we break above this resistance where we're at right now, we're likely to retest the previous peak. And if we take that out, that's a technical breakout. And that tells us that basically bonds are going to absolutely crash and yields are going to spike through the roof. And then we're going to enter into an environment no one has seen, unless you're, 70, 80 years old, in which case, you probably have experienced it, but, you're probably senile. So we can't trust what you say anyway. So that being said, nothing against old people. I'm just messing around. That being said, let's jump right in and take a look at what's going on. More importantly, though, so what came out of the Fed minutes today? Basically what we expected. People were anticipating that the Fed is going to basically say they're going to run off, 75 to 80,000 and, or I'm sorry. Yeah, right. Yeah. Just pretend like whatever the denomination of currency that I say at the end doesn't matter, because it's all like made up numbers at this point in time. They had, I think, initially anticipated or stated that they were going to basically start selling off assets, or realistically, they're not actually selling them. They're letting them run off of the balance sheet. And they were essentially planning or expecting, the market was, or whoever, analysts, were anticipating somewhere around like 70 to like 80 billion, 70 to 80 billion dollars per month running off the balance sheet. And then the Fed came out and said basically they were going to do like 100 billion, I think 95 billion. And then on top of that, people are anticipating however many rate hikes, 7 or 9 or 11 or 1,000 rate hikes, all for like 25 basis points. But nobody believes it'll ever happen because the Fed will crash the markets and they can't do that. Well, they came out basically and said, more likely than not, they're going to be doing 50 basis point hikes and probably a couple of them. Now, granted, they should have already been doing basis point hikes. The last one should have been 50 basis point hikes. I mean, they're total clowns. But regardless, that was enough to spook the mountain markets. And then on top of that, did they really spook the markets, or was it all already in the charts? I mean, we basically got a massive bear market rally back to retest. The reversion to the mean play literally played out perfectly on basically every asset. It played out on crypto, it played out on the Nasdaq, it played out on, S&P, Dow Jones, literally everything played out perfectly. So that's all we can ask for. At this point in time now, we have to look at where's our targets back to the downside, assuming this rejection continues. So at this point in time, the Fed says they're going to do 95 billion per month. They're not just going to start off at 95 billion. They're going to, wean off the balance sheet. So they'll probably do some, I don't know what the actual numbers will be, but let's say over the next like 4 months, they will start running off, like letting more and more mature and then not repurchasing. So typically what happens is the Fed's balance sheet is like, say, $9 trillion roughly. And then every month they have short duration bonds or mortgage-backed securities that are expiring. So they're basically reaching maturity. So normally what would happen is they would just go away and then they're gone. And then the Fed would purchase more to replace those just to keep the balance sheet the same. So that's just to stay neutral. So what they're planning on doing is not repurchasing those up to a point where they get to 95 billion per month and then running down the balance sheet over the next few years. So at 95 billion a month, just call it 100, that's 1.2 trillion per year. And they basically have added like $4 to $5 trillion in the last couple of years. So that's still over like 4 years worth of letting assets run off the balance sheet. So let's be real. The balance sheet will never get back down to $4 or $5 trillion. It will never happen because the next 4 years, they're just going to keep no, it's not going to happen. So let's be realistic. What they're starting to do is they're probably going to do like 20 to 25 billion per month for the first month, and then maybe 40 to 45, 50, and then 60, 65, 70, and then 80, 85, 90, up to the 95. So it'll probably take them 3 or 4 months to essentially allow these to run off to reach like maximum capacity. And then once they reach that 95, they're just going to run off 95 consistently every year, every month. So that's essentially what the plan is at this point in time. And then obviously we can expect next month likely a 50 basis point hike, and then probably more 50 basis point hikes on top of that. So what does that mean? It means exactly what we expected. So we've been talking about the Fed tapering their balance sheet, and then we've been talking about they're obviously not going to be buying more assets, more mortgage-backed securities or bonds. So that's exactly what we expected. We've been expecting, obviously, that they're going to have to pick up the pace, and tone down inflation because it's obviously out of control. So again, right on track with everything we expected. So there's no surprises here. The market is surprised because they're so used to the Fed just holding their hand on everything and jawboning and never actually doing anything, that the market expects that when the Fed has literally been telling us for the last couple years exactly what they're going to do in advance with advance notice, written, stamped and delivered from Jerome Powell at press conferences, answering questions, everything. I mean, they have been, if there's one thing you can give the Fed credit for, and I mean, I'm reluctant to ever give them credit for anything because they're total trash pieces of shit. But if there's one thing you can give them credit for, it's transparency. They have been blatantly open about everything they're going to do in advance with full notice the entire time. So there's been no surprises. So if you were surprised by what took place today, you're delusional because they've been telling us what was going to happen. So now they're telling us what's going to happen into the future. And even though they're shady scumbag pieces of shit and we shouldn't trust them, we have to trust them because they've been, open and honest about what they're planning on doing. Even though they suck and they're horrible and they're literally wrong about everything, we still have to trust that they're going to at least try to do what they say they're going to do. So that being said, this is a not at all bullish situation for the market. So rates are only going to go up from here. We know that. The balance sheet is going to run off, faster and faster over the next few months. We know that. So there's nothing bullish about that. There's literally zero bullish about what's taking place right now. Speculative assets are going to continue to get hammered. Safety plays are going to be where everyone runs to. And in the meantime, if the bond market continues to get wrecked because yields continue to rise much, much higher than the Fed funds rate, bond market's going to get wrecked as well. Now, granted, we've hit some key levels on the bond market, but it doesn't look good. It does not look good for bonds. And I'm going to tell you right now, we had a nice little rally going into the end of the quarter, but old people, retired people, people that own bonds, which is pretty much old retired people, they're not happy about losing, 7, 10, 12, 25% of their bond value to get, 2%. That's not functional. And we've been seeing the bond market outflows bleeding out at a faster pace than we've seen damn near in history. Now, granted, some of these numbers are skewed because the bond market obviously is bigger than it's ever been in history. So record outflows could just be the equivalence of the outflow in a previous time in history. But regardless, without adjusting for, inflation or time or, value of money, whatever, we're seeing record outflows out of the bond market. And then on top of that, we have all these geopolitical risks where, a lot of this rally in the stock market, in the bond market, in the housing market comes from foreign investors. And all of a sudden, some of these foreign investors might not feel safe. I mean, if I was a Russian oligarch or, Chinese or, one of these other countries, perhaps, Middle Eastern, I probably wouldn't be too hype about having tons of money tied up in U.S. equities, real estate, whatever. Because we've already proven now through these sanctions and everything that if push comes to shove, we'll just take your stuff with no rule of law, no nothing. We'll just take it. And then after that, you can fight in court to try to get it back. And there's now a new precedent where, the U.S. has always sanctioned people, Europe has always sanctioned. There's always been sanctions. But this is where we have actually kind of crossed the line into new territory. So we have to be real careful here. And then, obviously everything going on in Russia, in Ukraine is a big deal. The media has been very, very one-sided and basically is portraying this situation as Ukraine is this victim and Russia is a bully. But they're not talking about what led up to this. And again, I'm not siding with Russia. I'm not siding with Ukraine. The whole situation is just dirty and messy and ugly. Anytime you get into these old situations that have been going on for 10, 20, 50, 2,000 years, whether it's in Asia, the Middle East, wherever, whenever you get into these things, they're nasty. And there's no good guy and there's no bad guy because they both have times where they did good and bad. But we know that basically the U.S. and, basically put in a leader in Ukraine basically, pulled off like a coup type situation and had been slowly creeping in to Russia's territory. The same way that we were aggressive towards Russia when they wanted to put bases on Cuba, and then we sanctioned Cuba, and it basically led to all the tensions there. We're just doing the exact same thing. We're basically creeping up on Russia's doorstep. So again, I'm not trying to take sides on this, but we have to be real, real careful. And now the media has gone into this crazy frenzy where Ukraine are these massive victims and Russia is, the big bad antagonist and everything. And now the truth is coming out about all this neo-Nazi stuff, about all these Nazis are being exposed in Ukraine. It's like a Nazi hotspot. And then, essentially they were all like brought into the military and now they're helping to fight. So now the Nazis are the good guys. You can't really pick sides here because the waters are so dirty and muddled. But I mean, if there's one thing we know, it's that there's no good guy and there's no bad guy here. Ukraine is literally like top 10 countries in the world for most corrupt. I mean, so let's not portray them as victims. And now what are we doing? We're doing the same thing we've done previously, hundreds of times. We're transferring all this weapons and equipment and military stuff to a country that is temporarily favorable to, the allies. But in all reality, what ends up happening every time? Bin Laden, Saddam Hussein, all these different leaders end up basically with a bunch of money and a bunch of, weapons of war and a bunch of experience in war, and then eventually comes to stab everybody in the back. So, that's basically what I expect here. So let's be real careful about all this whole, the war is going to be over soon. Russia is pulling back. Ukraine is winning. Everything's going to be gravy soon. The sanctions are going to go away. Things are not getting any better. If anything, they're escalating. These wars don't end in 30 days. People are acting like, it's been a month and Russia hasn't wiped Ukraine off the face of the earth yet, so Ukraine is winning. No, that's not how it works. So let's be real careful here with how we try to get overly bullish on the markets when we still have a ton of things pushing. We have so many headwinds, the most headwinds we've probably ever had in existence right now. Potential famine, food shortages, energy spikes, massive amounts of geopolitical like risk and, de-globalization of the entire world simultaneously, all while we have, supply chain issues, money printing, poverty levels, housing and crypto and stock market bubble. So right now, in my opinion, best time to be defensive, the most defensive. So that being said, let's jump into some technical analysis. I just feel like we needed like a little brush up on why we're not getting like crazy bullish on this stuff that's going on right now. Because there is a ton of stuff going on that is not bullish at all. If anything, there's a lot of bearish stuff going on right now, and the market just hasn't swallowed it yet. So here we have the TNX. Obviously, new highs once again, 2.6% on the 10-year Treasury yield. I mean, this thing is just ripping. So we have broken through another key resistance level at this point in time. Let me go to let's go to the weekly. We have broken through another key resistance level. So we have our red fib right here, which is the 0.5, and we have broken above that now. Now, granted, this is on the weekly. We haven't necessarily closed above it, but it was acting as resistance. That's also the 886 in yellow from the top right here. The 0.5 is from all the way in the top from the 1980s. So at this point in time, we have the remainder of the measured move right here, which would take us up to essentially 3%. We have a retest of the highs, which would take us back to, basically 3.26%. And then we also have this massive descending resistance line that we have already clearly broken through. Now, granted, we broke through it right here, consolidated for a bit, and then we actually rolled back over. But as far as I'm concerned right now, this looks extremely bullish. Extremely bullish. I mean, we've already rolled the 200 exponential back up. It's about to cross back over the 200 simple, and the 200 simple is basically flat. So we're all but entering into a bull market, in bond yields, treasury yields on the weekly. Obviously, the daily is already very bullish. And then if we go out to the monthly, we're basically at the 200 exponential and simple, which is typically where we get rejected right here. But at the same time, every other time we led up to that level. So here when we got rejected back in 2018, we entered into a bull market based on like the TJD, TDMACD, and some of our other indicators way back here in like 2013. So it ran up for like 5 years before the rejection. Now, granted, it oscillated in the range in the meantime, but now we're just now flipping this over bullish. The time before that, You know, we basically, what, it was January 2005, and then we basically got rejected and rolled back over in 2007. So we had like a multi-year pattern every time we see this flipping over. So there's potential that this could run for multiple years. And we know for sure that if we break above this level, if we get a monthly close above 3.1, it's a technical breakout. So no time, this entire time back here from the 1980s, 1981, which is when we peaked. And then we actually went into a bear market confirmed right around like the 91 roughly on the monthly. No time did we ever take out the previous high the entire time through here. Here we have a little double top right here, but that's all like, you know, one move. And then again, never take out the high. This arguably you could say, oh, that was the high. But again, we put in a lower low right here and then we take out the high. So this is really just one move. And then that's another move and then another move. And now here we are potentially getting ready to take out this high. Now it's still a little ways to go. I mean, it's still, you know, 50 basis points or, you know, 0.5%. So maybe it doesn't happen. Maybe we get rejected right here at the 200 exponential and simple. Maybe it rolls back over. But what we do know right now is that we are threatening levels of a technical breakout. And then if we just turn back on our, let's switch off of log scale. And then if we just look at the resistance here in green, I know there's a lot going on right here, but every time we tap this green, we basically got rejected. And now here we are. Now, I mean, let me turn off the moving averages so it cleans it up just a little bit. I know it's still pretty crazy. But just look at this green right here. This is a rejection right here in 87. And then we literally just get rejected over and over again and never close outside of it with the exception of technically, and you could argue maybe my chart's not drawn perfectly. Maybe it is, whatever. But here we have a slight push up and then a push back down and then we break down and capitulate. And that was basically when we top out in 2018. You know, that was Powell basically, you know, starts rolling over, everything's collapsing, and then, you know, pulls back. So now here we are. And again, I'm going to turn this off for a second. This was our close at the end of last month. And now this is our candle for this month. This is the biggest breakout we have ever seen from this trend line dating back to, you know, 1987. So we have confirmed a breakout. Now, technically, what could happen right here that this would not count as a breakout or we wouldn't be like that worried about it, etc. Okay, it's possible that basically this gets rejected. It rolls back over, you know, goes back down here, consolidates, and then breaks back inside the range, and that's our rejection. And it just hit the moving average, and that was it, and it's all gravy. This was our target, obviously, from way back here, so that would make sense. But the aggressiveness of this move leading up to it, this candle right here, is like nothing we have ever seen coming into resistance. We can look at this chart and see only a couple times where we've ever even had, you know, candles that aggressive, and they have not been at resistance. So when we see, you know, a little indecision at resistance, it's one thing. When we see a big powerful push up to the resistance, a close, and then a gap up and it keeps running, that usually is like confirmation of a technical breakout. Now, could it come back down here, retest this and then break down, or retest this and then go back up? It definitely could. I don't want to get like overly bullish and say this is it, bonds are going to crash and, you know, rates are going to rise exponentially. But let's be real. If you've been a bull on bonds for the last 2 years, you're a retard. You're a fucking retard. I mean, the chart has been very, very clearly saying bonds are trash. You don't want bonds. You're a retard if you buy them. So there's no reason to get bullish on bonds right now until we see some kind of indication. You know, and a lot of people for the last couple months have been coming out talking about how they're buying bonds and this is it. This is the big one. I mean, sure, go ahead. How are those doing right now? Oh, they're getting wrecked? Okay, good. Awesome. So here we are basically pushing up to key levels. Now, could we hit the 886, top out and roll over? It is possible. And to tell you the truth, when we hit the 786, that is the last level that I look for a rejection before we basically confirm we're going higher. So essentially, if we make it higher than the 786 and close a monthly above this 2.66 level, we're probably going to head to 886, see a little resistance right here, and then eventually just break out or at least come up here and double top. You very, very rarely see the 886 act as resistance and stop the move. It's usually just like a key level to basically see some temporary resistance and then load back up for the big move. So looking at the monthly here, this still looks really freaking bullish to me. I mean, we're in the bullish control zone. We have all green histograms. We're going parabolic right now. We have the blue slope line on the TJD, TDMACD. You know, everything looks super, super bullish right now. Now, the only thing is we are running into the 200 exponential and simple. So the fact that we're there, this definitely, we would expect this area to act as resistance. Either a temporary rejection or at least some kind of like chop resistance, whatever. It has done so many times in the past. So we don't want to get bearish right here on bonds, but we don't want to get bullish right now on the yield either, because we're at resistance areas. But it does look like we expect continuation. So that being said, the number one thing that we are looking out for, more important than anything else that we look at, the number one most important thing of all the charts, all the technicals, all the fundamentals, all the geopolitical, everything we talk about, the absolute most important thing that we are paying attention to that has number one priority over everything else is this level right here, the 3.18 level on the monthly, because that is a technical breakout. If we break above that level, I would expect the yields to go absolutely parabolic and bonds to just absolutely crash and literally record outflows in the trillions of dollars like we have never seen in history. And what is that going to correspond with? Well, probably Fed tightening, inflation out of control, and them having to do something about it. Because that's going to start looking like, you know, periods of the late 60s, early 70s. So that's what we're looking out for. Remember, though, every data point that people use that is in this period from 1980 till today, if anyone is using any examples and they're saying dates that are between the 1980s and now, they're wrong. Because something is different right now that has never happened in that 40-year period that is happening right now. And that is literally runaway inflation. And you can say, oh, it's the money printing. Oh, it's the bottlenecks. Oh, it's the supply chains. Oh, it's the policy. It doesn't matter. None of that matters. The fact of the matter, the one thing that matters is that there is, in fact, inflation right now. Okay? So is it worse than anybody thought it was going to get? Is it exactly what you expected and they're undercounting it? Doesn't matter. What matters is there is 100% inflation going on all over the globe right now. And as long as that is the case, no data points in this last 40-year period, when someone says, oh, the Fed will step in, they'll never raise rates above this, as soon as something breaks, they'll pull back, you know, whatever their argument is, the housing market, the whatever, it's wrong. Unless it's using data points that are older than the 1980s, because that's the only thing that's valid at this point in time to compare. So that being said, this is so important. I think people downplay or underplay or just do not realize how important this is. This is the most important thing. So that being said, let's take a look at TLT. So TLT broke down from that key level of support, obviously just continuing to look horrendous. You know, we hit that key support level we were paying attention to, broke down from it, came back up, filled the gap. And you know what, to tell you the truth, this doesn't look good. It looks like it's ready to go lower. So we'll have to see, you know, anytime we're consistently putting in lower lows, I'm not going to just come in and try to pick the bottom on something. So, you know, what are the levels? Well, you guys know the key level we're expecting is basically somewhere down here. We're expecting somewhere around July, a level of like 116 on bonds and, you know, basically hitting our target. And that is the bottom of the macro channel as well as the bottom of the descending, you know, micro channel. So for now, that's what we're looking at. It looks like that's where we're going. So U.S. oil. So obviously we've been talking about how this looked like it was getting ready to break down. We got the 821 cross on the daily, and now we're coming down here to retest the lows. So if we do come down here to 94.65 and get a close around that level, it's going to look like a descending triangle. Okay, yeah, so we have basically this ascending resistance that we had from before, and then flipped it over as support when we got the technical breakout. This was our big oil spike we've been talking about, and now here we have, you know, what's amounting to a descending triangle. So, you know, using basically the same data points, you know, we basically have our top up here, and then we have a bottom down here, and then we have our top right here, and then this is still in the process of forming. So yeah, if this ends up being the bottom, you know, it's not quite a descending triangle, but if we come down here and basically just find, you know, a horizontal support, that's going to basically just look like a descending triangle, and obviously that is, you know, basically a topping pattern or bearish pattern. So we would expect essentially a measure move breakdown from this. Now, does that mean oil prices are going to go back to normal? Does that mean gas prices can go back to normal? Does that mean energy just not going to be the trade of the future? No, I don't think that at all. I think we're just going to come back down here and retest some of these key levels. Losing this ascending support was key, and now basically taking out this low is key once again. So we've already lost one key support. If we lose this one right here and we get a daily close below that level, it's going to look like we're coming down here to 82.97. But anytime around that level or down into this level, that's going to be our 200 exponential and simple moving average. And then we also have like the bottom of our ascending broadening wedge that we've been watching. And then anytime we're back around that level from like the mid 60s to the low 80s, it's going to look like we're looking for an opportunity to load back up on our positions. Obviously, we've been long energy this whole entire time, been taking some profits, scalping some nice positions. But the truth is, when this thing breaks down right here, this is going to look like a buying opportunity, because the macro, nothing is going to change, in my opinion. Even if we go into a recession and we see, demand falling for gasoline or oil or nat gas or any of these things, I still don't think that all of a sudden, like this energy trade is just going to blow up and it's going to be done with. Because we have basically, I'm going to turn off the drawing tools once again. We have basically confirmed, this is the monthly chart now. We basically have confirmed back into a bull market, for the first time since. I mean, granted, there's a huge lag on this chart because it's monthly. We chopped around quite a bit back here, and then we finally confirmed bullish somewhere around like 2002. And then we just went absolutely parabolic. And then we topped out in 2008. That was our record all-time high. So now we have basically confirmed back into a bull market here. Technically, we tried to do it right here, but it failed in 2018. And then here we're doing it again, confirming. And we're getting what looks like a top, a blow-off top rejection. But that does not mean that this doesn't come back down here over the next like few months or even like a year or so, and then just retest the key levels, the 200 exponential or 200 simple, and then go higher. I mean, I think honestly, we're probably looking at all-time highs on oil prices sometime in the next, 2 or 3 years. Because the truth is now, everybody realized all this like, rainbow and butterfly green energy bullshit is garbage, and it puts your country, your nation, and the world, at risk. So they're not going to be able to keep playing this BS. They have to actually, energy now is important again. You can hear the U.S. politicians and, Congress, all them talking about, and Biden, blaming oil companies. Oh, you guys need to drill more, and you're not doing this because you're just taking all these profits and you're not reinvesting and you're giving it back to shareholders because you're greedy and you're bad people. If you had a business and the regulators came to you and constantly said, we're going to shut down your business, you're a scumbag, we hate you, we're going to close down your business. And then every month they showed up and they put signs on your window about how terrible of a business you are, and people painted graffiti over it, and they said how you're destroying the world and you're killing everything and you're scumbags. Would you continue to invest money into that business while you're not making money, while you're losing money, or you're barely making money over like years, while every day the regulators showed up, or every month people spray painted your front of your building and you were the bad guys and you were horrible? No, of course you wouldn't reinvest in that. They tell you, we're going to kill your business. We're going to put the oil and gas industry out of business. Green energy is the future. So they literally have been saying this, drilling it into these executives and these companies, these profitable businesses that have a responsibility, to make money. That's their job. And they've just been getting hammered by regulations and all this stuff from the government. And now all of a sudden, the tables have turned. Now all of a sudden they're profitable. Now all of a sudden they're doing good. Keep in mind, oil futures was negative, not, April of 2020, this was completely crashed. So not 2 years ago, this was just absolutely wrecked. And, some of these companies were probably looking like, oh my God, we might go bankrupt. Like, what the hell? So let's keep in mind, that was less than 2 years ago. And now all of a sudden, and this is a lag industry, they can't just turn on oil pumps overnight. They don't just start fracking again tomorrow because now oil prices are high. It doesn't work like that. There's a massive lag on these commodities and oil production and refineries and all this stuff. So all of a sudden now the regulators are making them out to be the bad guys still, after they've made them out to be the bad guys forever, when what they should be doing is kissing their asses. They should be saying, please reinvest. We were wrong. We're going to roll back all this stuff we've done, all this extra regulation. We're happy to have you. We realize now how important energy is. Until we can build a sustainable future, we need what we have right now. And that is an absolute fact. So that is what they're doing. They're trying to portray the oil and gas industry like they're these evil, horrible people. And the truth is, what happened previously at some of these peaks was they reinvested and they built all this stuff. And then what happened? Prices crashed back down and never recovered. And then again, through this area, they were skeptical to reinvest along the way. And then, we started getting fracking, and fracking's doing well. And then all of a sudden fracking's the enemy again. And then we're shutting that down. So you can understand as a business person, someone whose job is to make profit and return or increase, shareholder value or wealth, why they wouldn't just be like jumping on this quick surge of oil prices all of a sudden because of, wars and supply chain issues and all the crazy stuff going on. Why they're not just jumping to like reinvest all these profits into their companies when they're still being made out to be the bad guys. So that being said, I would not be surprised. This looks like a topping candle to me. This is a shooting star. It's a very long wick, clear rejection of higher prices. It looks very toppy to me. And, to tell you the truth, we still have the better part of the month left, 3 weeks left. So at this point in time, there's a high likelihood that this candle ends up bearishly engulfing the previous candle, that shooting star. And then we actually go down here and start retesting, 87, or if we just retest the 200 simple, 72. If we come all the way down to 200 exponential, which is less likely, that's like 62. I look at those as an opportunity to basically buy the dip going into the beginning of a bull market. Is it possible this could happen and we basically roll over and get rejected and go lower? It is definitely. And should a situation like this happen, I will gladly sell back into the entry. But the key to pay attention to right here is anybody that basically we broke above, went bullish, and then they bought support right around these levels at either the 200 simple or 200 exponential, basically sold off through it, either got stopped out or whatever the situation is, but then it comes back up and you just sell the retest. So you can basically take a minimal loss if you're wrong. But the opportunity is exponentially, it's amazing. Because if this is right and we come back down here and retest, that's the opportunity of a lifetime to basically get in before we take out the all-time highs and essentially run up, to, I don't know what it's going to end up being, $200 a barrel. 150 is the first target, then 200, maybe 250. Who knows? And maybe that has to do with not necessarily the value of a barrel of oil going up in, real terms, but in nominal terms, because there's massive amounts of inflation and all these currencies are worth less. So realistically, is a $250 barrel oil the same as 125 barrel oil? Well, it might be, but the currency has just gotten that out of control over the next couple of years. And we don't know. Maybe that won't be the case. Maybe they won't, have all this monetary and fiscal stimulus, and maybe just oil will go through the roof because people will realize how much they need it and how this whole clean energy, situation is BS. But right now, it looks like we're topping. We have a hard sell signal on the monthly. We have a blow off top, amounting to. Here we had something similar. Each time we see, obviously, this was a buy, sell, buy. That was a good opportunity to get in. We had the buy, sell, buy right here. Good opportunity to get in. And now we're seeing hard sell coming out of the bullish control zone. Hard sell coming out of the bullish control zone. Now, this one went sideways for years. But, this one, hard sell coming out of the bullish control zone. We don't want to get stuck in something like that. So, in my opinion, key time to be, if you haven't already taken profits on oil trades, I have been. I plan to continue to still have some of my positions open. Obviously, some of these companies have done better than others, but something like the XLE for diversity, Exxon, Chevron, BP, whatever your, pick your poison. But, this is still going to be, in my opinion, a lasting trade into the future, but it looks very toppy. Here on the weekly as well, hard sell signal coming out of the bullish control zone. That corresponded with our previous three tops right here. This one obviously broke out and kept going, but it does look like on the weekly, we're coming back down here. And again, the 200 exponential and simple line up at those low 62s. So that is the area that I'm looking for to reload on my oil positions. But in no way, shape, or form am I bearish on energy, oil, commodities going into the future. Short term, I do see some downside though. All right, so on to the Dow Jones. So what happened with the Dow Jones? Exactly what we said. We got the reversion to the mean play. We put in a lower high. And now look, we've broken down from the 200 simple. We're back on the 200 exponential. Barely closed back above it at the end of the day today. But here we have a hard sell signal on the daily. We have a bunch of red histograms. And we're barely hanging on to support. And we know what's going to happen here. If this breaks down below the 200 exponential, this is going to continue going lower because we're still inside of the same pattern. You know, we essentially broke out of this descending channel. So we had a technical breakout depending on how you draw it. But all we did was retest the key levels we were paying attention to. You know, obviously we had broken above this key resistance. We had tested a bunch of times, and then we tested it as resistance once we broke back below it, and it did act as resistance. The moving average is acting as resistance. Our key area, you know, this green support turned to resistance, and now I expect us to go lower. Now, we did have a technical breakout, but much like when we were talking about with the yields, you can have a technical breakout, but if you don't take out the previous high, you haven't actually like switched the trend around. So we really need to take out 35,760 on a daily before I can get bullish on the Dow Jones. Right now, not at all. Obviously, there was a nice play to be had. You know, we took quite a few of the reversion to the mean plays in cryptos and stocks. But as far as I'm concerned, this looks like it's going lower. Now, if it comes down here and it basically puts in a higher low and then starts rolling back over, maybe then it could look bullish. It start to look bullish. But a hard sell signal, bunch of red histograms. We do still have momentum in our favor, but it looks like we're about to lose all the moving averages. Doesn't look good to me. And let's dive in just a little deeper on the Dow, and then we'll just take it a little easy on the other indexes. So we still have the 821. I'm going to turn these off. Have crossed to the downside. We rallied back up with this massive weekly candle, and then what did we do? We went sideways. We had a big rejection candle right here, and then what happened? Well, it doesn't look good. So it looks like, realistically, if we close this weekly candle below where we're at right now, below 34,500, it's going to look like a rejection of the 821, and then we're just going lower on the weekly. And it's going to look like this just rolls back over, this just rolls back over, and then we start, you know, looking at the lows again. Still looks very likely that if we don't cross this green back to the upside, then we come down to the 200 exponential and simple, which also coincidentally is the Rona high, the pre-Rona high, I should say, which was 30K. So we've been through this a million times. Every time we have crossed this to the downside, we ended up hitting the 200. We had a couple little fake ones right here, and then here we crossed, hit it, here we crossed, hit it, here we crossed, hit it, here we crossed, blew through it. So the likelihood to me, if we don't save this on the weekly, if we don't close back above the 821 and confirm this back to the upside, I think there's a very, very high likelihood we end up at 30K. And then if we go to the monthly still looks, it looks terrible to me. It looks absolutely horrendous. We have left the bullish control zone. We have a hard sell signal. The last time we had one of those was the Rona dump. The time before that was the 2018 dump right here. And then, you know, obviously we've seen it quite a few times. Now this doesn't count because we didn't leave the bullish control zone until all the way right here. But each time we have one of these, we get a varying level of, you know, violent dump. So do I want to be buying when we're going into what looks like bearish trend? No, not at all. This looks like exactly what we said. The retest of the 8 on the monthly, a rejection, and it looks like we're headed back down here. So we're going to pay attention to a monthly close. Obviously, we got plenty of time on that. Below 33K, key levels like 32K, and then obviously down here at like, you know, 28, 29, 30K. We see all red histograms. We see red has finally flipped over. We have lost the slope line on the TJD, TDMACD. So does not look good to me. Basically just looked like a dead cat bounce, a bear market rally, and a rejection at key levels. The SPY obviously looked a little better. It broke above this key level right here. So broke out of, you know, the resistance, broke above this high right here. Actually looked okay. Could not hold the 200 simple, could not hold the 8, could not hold the 21. We still have price action above the 200 exponential. So there's still a little hope for this. But when we look at the other two indexes, and then we look at, we have 3 to 1 basically, and the SPY is outnumbered, you know, doesn't look good to me. So we still have obviously blue slope. We have 4 red histograms and 1 green one, and it looks like we're failing that to hold 821. So we'll see what happens. Key levels to watch: 440 and 427, and then obviously we'll look out for like these lows to be revisited. So the Nasdaq, I think, is this one to me is painting the clearest picture of what's happening right now, which doesn't surprise me because it consolidated for a while at the top after a massive run, but it basically is this is a textbook chart of the reversion to the mean play that we always talk about. So once we break out from our bull trend, which obviously we've been in forever, once we lose the 200 exponential and simple moving averages, which was right here, which is when I got very bearish, obviously, we flip them over bearish, we get an immediate retest of the 200 exponential, and that fails, and then we go lower, and then we come down, we see bullish divergence starting to develop down here on some of the other indicator oscillators, Not so much on this, more like right here we do, and then essentially like a double bottom. So technically we see a little bullish divergence. Technically this would be a third drive, you know, technically. But after that, we basically put in a double bottom, and then we get the actual reversion to the mean play, retest the 200 exponential, the 200 simple, and then get rejected. We fail to hold those, and now they have flipped bearish again. So we talk about these areas where the market's kind of deciding, are we bullish or bearish now? When it comes back up and retests it, that's basically the last attempt for people now to exit positions at break even. Because what people do is they buy support on the 200 exponential, and then eventually it breaks, and then they're like, oh, hang on, we're not going up? Okay, hang on. So when we retest it, I'll exit my position again, and I'll go neutral, and then see what happens. And that's what this chart looks like to me. And that's why the Nasdaq is so clean, because we're confirmed right back into a bear market. Hard sell signal, bunch of red histograms, still have the blue slope line. It's still above the 0 line, but it looks like we're about to cross the 821 back to the downside. Does not look good to me. So looks like we are going much lower. Much lower. And the Russell, again, just looks absolutely terrible. Even weaker, even worse. Did not even make it back up to the 200 simple. Got completely rejected at the bottom of the channel. Literally, I mean, hit our target perfectly and is headed back down to the bottom of the range. So I expect this to put in a new low before anything else does. And I expect the Russell to go much lower. It already tagged the 236. So our next real target to the downside is the 382. I thought I had one in there. Maybe not. We'll just add one. So that'll be our next target to the downside, somewhere around like 1720 to like 1760 area. That's what we'll pay attention to. So again, Russell looks absolutely horrendous. Listen to all these people talking about small caps and the Russell and how they overperform during tightening cycles and all this stuff. Listen to who they are. Write their name down on a piece of paper. Crumple that piece of paper up. Throw it in the garbage, because they're fucking morons and you don't ever want to listen to them again. Because what's different this time in the last 40 years? Oh, that's right. We have inflation. Oh, that's right. So you think all these companies, these trash bag zombie companies that make up the Russell, these small cap garbage companies, are all of a sudden going to do well? What's going to happen when they can barely service their debt and they're not even like profitable companies? They're literally just making enough money with earnings to pay the debt note, to pay the interest on their debt, and never pay down the balance. It's like if you have a friend who's always broke and making poor decisions, and they have a credit card, and the credit card's maxed out, and they can only ever make enough payment on the credit card to pay the interest, but they're never actually paying down the balance. That is what these Russell companies are doing. They're zombie companies. They're dead companies, barely hanging on, only able to just pay the debt note. So what's going to happen when their debt that they have borrowed starts coming up and maturing, going into a rate hiking cycle, and all of a sudden they're going to be paying, you know, double what they were paying before, or triple or quadruple? So they're going to go from paying, say, you know, 2% to 4% or 5% or 6% or 8%. You know, depending on how high these rates go, or, you know, what kind of rating this company has, determines, you know, basically, like, it's like a credit score for a person, how likely they are to get a loan, and then how likely they are to get a good interest rate on that loan. You know, your friend that's useless human being can get a loan at like 28% on a credit card. You know, if you have good credit and you're like, you know, a responsible person, you could probably get, you know, a mortgage at, you know, whatever, 2.5%. You know, in the peak, obviously, now 5%. So what's going to happen to all these companies when they go from that 2.5% to the 5%, or from that 5% to 8% or 10%? They're going to go bust. They're going to implode. And that's what I fully expect to happen to a lot of the zombies inside the Russell. So if there's one thing I would be looking out for, I mean, look, we were ahead of the tech thing. It got absolutely wrecked. A lot of things just capitulated. I've been running my mouth about, you know, Kathy and the sinking arc and all this stuff forever. You know, we called the top on the majority of these tech stocks, especially the indexes, Bitcoin, all this. But if there's one thing that I'm honestly extremely bearish about, it's the Russell and small caps. I mean, they're going to implode. Honestly, that's my opinion. So XLE still pretty strong here, consolidating at the top of the range. Doesn't look particularly good. We see this bearish divergence. I expect it to play out. We see it in both our indicator oscillators. It looks like it wants to roll over. If we lose this 75.52 level, really, if we see the 821 cross to the downside, we want to look at these key previous support levels. But again, if I'm right on oil and that really does start to roll over and break down, we probably get a retest of the 200s. Now, where are they at when we get there? I don't know. I don't want to get overly bullish, or I'm sorry, bearish on XLE in general. But I think the energy trade is going to cool off here for a little bit. Still looks okay for now. Still looks okay for now. We won't get overly bearish on this, but I have locked in some profits already, and I plan on locking in profits if we start to threaten these areas further. So XTN transportation. So we were talking about this one. This is obviously one of the four horsemen. And what are we doing on transportation? Absolutely rolling over. It's getting crushed. So we see the key levels we pay attention to. The 200 simple cross above the 200 exponential. We put in a new high. That's probably it. And then obviously we break down here, flip this over bearish, try to save the trend. And now here we are, very clearly bearish, retesting the lows. This is the support level. This is it. I think we had this as a, oh, did we not? I might be thinking of something else. I was thinking we had this as a double top pattern on here, but that's basically what it's looking like to me. It looks like a double top. We basically have a support, which is where we're at right now. And if we lose this support, we basically have, like a rounding. I mean, you could call it whatever. It's not like a real pretty like Adam and Eve or anything. More just like a double top with like a little throw over or failed breakout right here. So fully expect I think I thought I had the blue fib in place. Okay, I got you. So that blue fib is from way down, but okay. So yeah, if we look at the green fib right here and we say we've almost touched a 236 multiple times, the next target is a 382. We obviously have a big cluster of support and fibs and what was resistances around this area. So that's the area we're really looking for, is like $67 on XTN. But I've been through this 100 times. Every time we break down from one of these ascending channels, whether we double top, whether we put in a new high afterwards, once we break down, we go into a very, very bearish like capitulation period, and they almost all correspond with essentially like a top around like the beginning of the year. So that's what I'm paying attention to. It looks like this thing's getting ready to full on just melt down. So transportation, not looking good. Look at the numbers on key transportation metrics. Look at UPS, look at FedEx, look at, container ships, look at freight, anything that you look at basically as a gauge of that. And I think we'll see the same weakness throughout the space. And that's going to tell us essentially when the transportation sector rolls over, when the yield curve inverts and then essentially uninverts and starts to roll back over after, we see energy spikes, oil and other various energies. And then obviously semiconductors as well. We'll get to that in a minute. That's literally the four horsemen of the apocalypse. That's our 2008 crash. That's our 2000 crash. That's every single massive crash we've had in history was preceded by those four things taking place. Now, other things, some of those things took place, and then we didn't have a massive crash. We just had a regular bear market. But every time those four things have taken place, all happened prior to our massive capitulation, like bear market, blow off top, 2000, 2008, all the big ones. So the four of them happening, and we were talking about this way before energy spiked. We've been talking about it forever. If we see a spike in energy, that tells us when that energy spike happens that we're looking at one of these capitulation level events. And that's exactly what happened. And that looks likely to me. So XLF now, financial, still looks like trash. Anyone that tells you this is bullish going into like rising rate environment just doesn't have a brain. They just do not understand how these places make money, how these banks make money. Banks used to make money borrowing it from people and then loaning it to other people. And they still make a little bit of money on the spread now. But that's not how they make their money anymore. They make their money now speculating on assets like stocks and things like that. Banks are not making their money how they used to, where it's like, oh, I'm going to borrow $100 from Susie and then I'm going to loan it to Bill. And then, we'll charge Bill 6% interest, but we'll only give Susie 2, and then we'll pocket the 2 spread. No, banks don't need our money anymore. There's no reserve requirements. We have fractional reserve lending. There's no argument. As a matter of fact, banks are not going to want to loan people money with knowing that the 210 have already inverted and we're likely going into a recession. Banks are not going to want to loan people money Because when they loan people money, they put themselves at risk. So if it looks like the housing market's about to crash, you think they want to give people house loans? Probably not. If it looks like, the economy's about to crash, you think they want to give people business loans? Probably not. If it looks like you might lose your job because we're going into, a horrible couple year situation, you think they want to loan you any money for a car or whatever it is that you want money for? Probably not. They would much rather collect your stuff when you can't pay for it and then, basically pull it back to the banks and take it for free. So banks are not going to put themselves at risk loaning a bunch of money right now. This is confirming back into a bear market. Looks terrible. Looks absolutely terrible. XLC communication topped out exactly at the retest of the 236, rolling back over, headed lower. This is probably the worst sector. XLP, so looks good. We're seeing consumer staples breaking out. We were watching these key levels, obviously the retest of that previous high and then the one right here. We're basically back at all-time highs. Looks like we're going much higher. We do have to be careful of this resistance. That's basically where we came back up to. So we do want to watch out for, potential like bearish divergence developing type situation up here. But consumer staples, something that, and this is probably, in my opinion, this is a lot of smart money front running the upcoming like recession, depression, like whatever. Because the money has to go somewhere. And historically speaking, consumer staples hold up very well during these periods because it's the stuff people need. So consumer staples, one of the parts of the safety trade. We've talked about this a million times. Utilities, safety trade, absolutely crushing it. Like, just blowing up right here. We're on our way. Now, it took way longer than I expected, but realistically, it looks like we're headed up to 80, and then realistically, we're probably going to 85 on this. Again, massive safety play. People love their dividends. They love their utilities, their consumer staples, all the stuff that people cannot do without. So real estate also doing extremely well for now. Now, this lags behind the rest of the market, so we got to be real careful with this one. But overall, looks good for now. So real estate, generates income, obviously, potentially in a massive bubble. Commercial real estate looks terrible. But as far as like housing and everything, until this situation cools off, even with rates rising on mortgages, I could still see this thing doing extremely well, potentially even taking out the top here and going much higher. So we do have to pay attention to this. Obviously, been on top of real estate forever. Still looks good for now. Do still have to be careful of, a potential lower high right here and rolling back over. But again, this is one that's very strong going into like recessions. Now, a year or two later, it could be a different situation when we see like housing bubbles pop and values coming down 10, 20, 30%. But that's way out into the future. And, the market is always trying to figure out what's right about to happen, not way out into the future. So, and then obviously the last one is dividend stocks, massive dividend stocks. People love dividends. You don't want to lose a ton of money on a dividend stock, but if you can find something that pays a nice dividend and is fairly stable, that's a place to hide during recession. So, VWO, Vanguard, FTSE Emerging Markets, obviously still just hanging out in that range until we break above and consolidate or below and consolidate. There's nothing really to see here. It looks like it's ready to break back down. I would fully expect this to go to new lows. DAX, Germany, just looks like it's rolling back over. 820 crossing back down. Just a failed retest of a 200 exponential and simple. Hard sell. It looks terrible. Probably revisiting the lows. CM50, China, trying to cross this 821 back to the upside. The most pathetic bounce for sure. It looks okay still for now, but very close to just rolling over. I'm not bullish on China, but the chart looks okay. UK 100 still looks by far the strongest of these. Still looks okay. Again, hard sell signal. Got to be careful. It's up at the top of the range. Don't want to see this print a lower high. If we see it print a lower high right here with bearish divergence, we don't have bearish divergence here though, actually. Well, it's sort of a weird situation. Yeah. Okay. So we'll see what happens with this. Still looks okay for now. The key level to just pay attention to, in my opinion, is still just this yellow ascending support line. And we're well above that for now. Got to be careful of a double top right here and some bearish divergence, but this still looks okay. It obviously didn't look good on the breakdown, but hit the 382 perfectly and then rallied from there. So, to tell you the truth, I would not be surprised after a 382 retrace if this is going to be bullish, just seeing new all-time highs in this thing running. So let's look at this on the monthly. yeah, I mean, still well above. I mean, it came down and touched the 21 perfectly. Still well above the 8. Reclaim the 821. Still looks very strong, but got to be careful of some potential bearish divergence on the daily and weekly developing. And then EWZ, Brazil. So is this thing topping out? It could be. It looks like it wants to, but again, I mean, there's some definite risk in Brazil, but I'm looking to buy the retest of 34 and basically, yeah, I'm looking to buy the retest at 34. So for me, this looks like an opportunity if it comes back down. Wouldn't be surprised if it still made it back up here, but this is going to look like a retest, reaccumulation phase. So yeah, that's it for the indexes. Flip over to our DXY, very strong, breaking out to the upside. Not what we wanted to see. I mean, I'm obviously massively bullish on the DXY, but it's not good for like the world. We talked about this in depth on the last stream, or maybe 2 streams ago. I'm not going to go into it again, but don't want to just see this thing just continuing to just melt up. It is not good for the world. Not good for anyone that doesn't have a job that gives them money in dollars, but dollar denominated debt. And at this point in time, we're basically consolidating above that 99 mark, and that's a key support level. So if we hold above this level, it's probably going to go much higher. We really want to see the dollar come off at least a little bit, but not looking like that's what it wants to do. So very, very bullish on the dollar. So TSLA, Tesla, had a nice little push up here, came back down, filled the gap. Hard sell signal. I mean, this is like the ultimate just consumer tech play. So is this just dumb money? I mean, it basically hit the measure move. We're seeing a pretty clear like resistance from these peaks as well. I mean, it looks like it's topping out again for now. Obviously Elon's like buying Twitter. They're, delivering cars. There's always some kind of like bullish catalyst for this. Let's be real though. Tesla doesn't trade. It trades based on technicals, but does not trade based on fundamentals. I mean, this thing is 100% speculative. ARKK just rolling back over, just getting wrecked again. It went to Kathy's head. She made a couple percent off her buy the dip and now headed much lower. Just going to continue to get absolutely wrecked because she's a horrible investor. SMH, so we see the Semiconductor Etf, again, rolling over, clearly topping out. Another lower high. I fully expect lower lows. This thing looks very, very weak. We've been talking about the semiconductor space, and here it is, ladies and gentlemen, completely getting destroyed. Back below the 200 exponential and simple. Looks very likely it's going to confirm into a bear market now. And then after that, that's the final signal from our, fourth horseman that essentially this is it. Massive blow off top, massive, bear market, which is going to be a phenomenal investing opportunity for everyone. So while it sounds like I'm bearish and I'm saying bad things, it's actually the best situation. If you're not like 60, 70, 80 years old, if you're anything under that, and the further under that you are, the better the situation is. If we go into some massive 2000 or 2008 or, 1930s type recession or depression, it sucks. And, I hate to like be bullish on it, but, that's where the real money is made. So, and that's what we're here for. Nvidia, again, rolling over, still above the 200 exponential and simple, holding strong for now. Took out the high right here for now, but doesn't look particularly great. This is like the strongest of the, semiconductors. Had a pretty big drop right there. We saw the same thing on Micron, or what was it, AMD? I think it was AMD. Saw a pretty big sell-off on AMD right beforehand. Semiconductors in general just don't look great. I mean, we talked about that in depth last stream or 2 streams ago also, so not going to do that one again. Netflix still looks like trash, absolute garbage, going straight to zero. Netflix is going to zero. Apple still very, very strong, probably the strongest. Don't want to see it top out right here, but it probably is, at least for now. Very strong. I mean, this is probably the strongest stock, like overall in the indexes. Facebook looks like trash, absolutely horrendous, rolling over, going back down to revisit the lows. Google hanging on for now. Definitely saw some serious pressure. Massive underperform on the breakout of this little bottoming pattern right here. Lost to 200 simple, so really got to see 2674 hold. I don't think it will, but we'll see. Amazon looks even weaker. And there's some like fundamental, like real bearish news for Amazon. I mean, if you got all these people like unionizing, and all of a sudden Amazon's going to have like unions and dealing with all that, I mean, that their costs are going to go through the roof. I mean, people are like, oh, it's only a couple million or a couple hundred million or like a billion. It's not that much. I mean, all of a sudden they have a bunch of costs or extra costs or additional costs or inflated costs that they didn't have before. So what are their earnings going to look like, especially if we go into like a consumer slowdown? I don't see this looking good for Amazon, and we have reconfirmed back into a bear market. So reversion to the mean, rejection, going much lower, in my opinion. All right, we did it. Who's next? Crypto? Let me jump over in the chat real quick. What's going on, Cool Sheet? What's up, bro? Crypto dead incoming? Yeah, you could say that. Honkiness. What is your opinion on USO and UCO? We could take a look at them. Oh shit, my bad. I did not mean to be muted that whole entire time. Well, you'll have to guess what I was saying. Damn, that sucks. All right, well, you saw the levels. Damn, that was all of crypto I was muted for. Well, I'll just sum it up for you guys, okay? Doesn't look good. Let's go back through real quick. So Bitcoin rejected off 200 exponential and simple, confirming back into a bear market. Looks terrible. Definitely rolling over. On the weekly, we have to stay above this level right here, like 43,000, or it's going to roll back over and look bearish. And we're probably revisiting the lows or the 200 exponential and simple. The monthly still looks very bearish. Looks terrible. Just oscillating inside those same levels. Looks like we're very much confirming into a bear market again, reconfirming, or the reversion of the mean played out as expected. People sold into it. So we went from buy the dip to sell the rip, and now it's bear market. So again, Ethereum trade played out perfectly. Rejected at the 200 simple, back at the 200 exponential. Looks ready to roll back over, bearish. Total market cap looks just like the Bitcoin chart. Bitcoin dominance looks like it's basically back at that key level. So the alts had a nice run. Then Bitcoin regained some of its market cap. If it gets above 42.50, it's bullish. If it goes below, it's probably coming back down to the bottom of the range. Matic looks terrible. Rejection off 200 exponential and simple. Revisiting the lows. I fully expect this at $1.35 soon. Avalanche looks slightly better. Still has a series of higher lows and higher highs, but probably goes lower. So see, okay, so this is a perfect example of talking about why we were waiting for a close above this level. So this trade setup was a potential trade setup we talked about if we closed above the 382, which we never did. We got rejected at the 382 consistently. We even put in a shooting star candle. So that is why, even when this was big and green and juicy and it was like, oh, but we're going to miss out. Half the trade's already over. No, we got to wait for confirmation. We needed the 382 to hold because it acted as resistance previously and it didn't. So we never enter into that trade, obviously. And if you did, you would have got trapped and it would have sucked because you basically bought the top. So we're at this ascending support. Looks like we're going to break down from this level. And when we do, it's likely we revisit some of these key levels. So we still technically have a low, a higher low, and then for now, a higher low. So we need this to hold probably like 76. Definitely needs to hold above 67. If not, it's probably going to new lows. So Avalanche, sorry, looking bad. And then here's Solana. So Solana, again, rejected 200 exponential and simple. Looks terrible. Looks like it's ready to just completely melt down. I mean, this thing looks like total trash. God, what a trashy piece of trash. BNB, same exact thing. Rejected at the 200 exponential and simple. Broke down below it. You know, I mean, this is all this. If this isn't literally the definition of a bear market rally, I don't know what is. Everything comes back up to 200 exponential and simple, and then everything gets rejected in one, like in unison. Everything looks like trash. None of these charts look good. You know, I mean, we talked about a couple things that look good, but none of the recent ones. None of the ones I said look like trash look good. Cardano. So this is it for Cardano. If it wants to put in, you know, like a right shoulder right here, I doubt it does. You know, Cardano is obviously not one of my favorites. You could argue and say that it's one of my least favorites, but doesn't look good. I mean, if it holds the right shoulder level around like 96, if it breaks down below $1, it's going to be in real big trouble. So you don't want to see this lose $1. Could it run back up to $1.27 right now and touch the 200 exponential? It really could. So is the trade a decent trade? No, because the stop loss is so big. It's really just not worth it. Cardano sucks. On XRP, looks terrible. Still looks just straight up trash. Yeah, I mean, this thing's just rolling over. Looks like it's headed back down to like 69 cents. This is garbage. Yeah, crypto looks absolutely terrible right now. Absolutely terrible. And then let's look at some pot stocks and commodities. So gold, again, just looks like it's ready to break down from this level. It has confirmed the 821 cross down. It's still hanging on to the support for now, but it really looks like it wants to break down. You could argue this is a bullish consolidation, but typically what we don't want to see is a bullish consolidation on a horizontal support line. We want to see a bullish consolidation, like putting in higher lows. We don't want to see this because this just looks like orders getting eaten through. It looks like the order book getting eaten through. So if we lose this area, it's going to look really bad. A close below 1919 looks very bad. A push up and break back above the 821 looks good. So really got to break above like 1930. Silver looks okay. It's hanging on to 200 exponential for now, but I mean, doesn't look good. This thing had an opportunity to potentially confirm back into a bull market, and it's looking pretty weak. And then gold silver ratio. So this is what we've been talking about. The gold silver ratio. Gold is back on top of the 200 exponential now. So now we have blue on the 200 simple. We have blue on the 200 exponential. So it looks like we're probably retesting the top of the range. And we know typically what happens is if gold gets a breakout, silver typically outperforms it, especially later in the cycle. If gold breaks down, silver typically overperforms to the downside or underperforms to like holding its value. So that would correspond with gold gaining value compared to silver would be a breakdown. So this chart right here tells me there's a very high likelihood gold is going to break down, silver is going to break down worse, more aggressively. So that's what I'm looking at. XPD, palladium, lost to 200 exponential and simple, looks bad. It looks like this thing is just getting ready to melt down, confirming back into a bear market after that like crazy rally. XPT, again, looks very bad. This is our monthly chart, and it looks terrible. This thing is about to confirm into a monthly bear market. I mean, the 200 simple is barely neutral. 200 exponential is already flipped over. This looks so terrible. This is so bad. Complete bear market, retesting the lows. I expect this back down at $900. This thing's going to go to $700. God, so bad. Okay, and now our pot stocks. So THCX, back down at the entry point. That's why you have to take profits on these things. Not financial advice, but you have got to take profits on these things. Looks like it's going to go lower. All these pot stocks look like they're going lower. What were we talking about with this? Oh, I think we were talking about if it came down and put in like a head and shoulders or whatever. Why did I have the stop loss way down here though? Definitely would not want to do that. I would look at something more like this. A tight stop loss on this. So we'll see. If this area holds over here, maybe I'll load back up. I still have small positions in some of these. I took most of my profits in Tilray. It actually had a nice pushback up based on its earnings. Estimate was -8. Reported was +9. So 17-cent beat. Oh man, crushing. And then surprise on revenue. Estimate was 156 million. Reported was 151 million. So it was like a little miss. So, I mean, not terrible, not great. I think they did like some kind of pairing up with like Whole Foods and Amazon. So I don't know. I took the majority of the profits on this position. So it is what it is. Hexo, again, right back at those entry levels. I mean, you just don't want to get stuck in these things while they're constantly making lower lows. Sundial, lost to 200 exponential and simple. It looks like it's going lower. CGC, again, took profits on this one. Absolutely played out beautifully. You know, nice quick 50% on some of these trades. And now I fully expect this to go back down to the lows. I fully expect new lows on these pot stocks until they prove themselves otherwise. And then Cameco, uranium. So took out the high right here, which is good. But now it looks like we are topping out. Bunch of red histograms. I mean, it's hard to be bearish on these energy plays. Uranium has still been staying strong. I think it pulls back. I think energy in general has a pullback, but I mean, these things could run. If they start creeping back to the upside and building momentum, I'm just going to load back up on them, you know, and it is what it is. But very bullish. Temporary probably has a little pullback though. So yeah, I think that's all we had on the agenda for today. Made pretty good time, even with the mute. Sorry about that, by the way. Cool Sheet says, yo, Mike Dead, like Bitcoin, bro. Eli says, Mike's still on mute. Honkiness, Mike. Eli, no sound. Yoshi, sup? What's up, man? Can't hear you, brother. Yeah. Sorry about that. My apologies, guys. Honkiness says I messed up the stream. Nah, it's not your fault, man. I was like clearing my throat and then I forgot to unmute it. Yoshi, LOL. Cool Sheet says agree. Lose the 200 and sell the 200. Yeah, that's that reversion of the mean play, man. If you're above it, we buy it for support. If we're below it, we sell it as resistance. And then Cool Sheet says, amazing what one day close in crypto can do. Yeah, I mean, it is what it is, though. I told you guys, we have to technically start to look at crypto again bullish once we're back on top of the 200 exponential and simple, and we have the blue slope. But for me, I need like a consolidation period above that level. And then what I usually look for to tell me that, okay, it's bullish now, is I usually look for some hard selling at the 200 that takes us below it, and then it gets bought up. A rejection of lower prices, a big wick to the downside. And then when that holds, when people buy that dip and the 200 holds and it doesn't, basically rejects lower prices, I get bullish. Because that to me is like the final test where it's like, okay, because if you don't get that final test, it literally just any volume comes in and it just completely loses that level and then you're trapped. And that was like your one chance to get out or take profits or whatever, short, etc. So you really want to see that rejection of lower prices above the 200. And we didn't get that at all. We didn't get anything even close to that. Matter of fact, we barely got any volume when we came back down to it. And leading into like some bullish potential catalysts with like the cult stuff going on behind Bitcoin and everything. Not good to me. Eli says, nice finish. Yeah, I mean, and again, we basically, we've been bearish since the top and we've been bullish since the bottom, but only for the reversion of the mean play. And you guys know me, you know my strategy. The last bullish play I take in a market is the reversion of the mean play. So from here on out, don't expect, if we break down from these levels and confirm bearish again, do not expect me to be talking about bullish plays or bullish, positions, etc. Because I don't counter trend trade. And once we confirm into the bear market, any bullish trade is a counter trend trade. So after that, it's basically just shorting our options. But yeah, that's going to do it. Rather quick stream today. I hope you guys enjoyed it. Appreciate everybody that showed up. Make sure to like and subscribe. Sorry about that little mute incident. Yeah, appreciate everybody, all the group members showing their support. Obviously coming up to the, with the whole rebalancing and everything going on with the quarter and then tax season, I'm always kind of busy around this time of year. But I'll be back to normal in probably like next couple of days or whatever. So I've been kind of sick lately too. So been a whole pain in the ass. But yeah, that being said, appreciate all the support. Take care of your families, take care of yourself, protect your principal, protect your capital. Don't get reckless. Don't get, all dreamy about these big upside potentials or whatever after a nice move. If anything, once the nice move happens, the bear market rally, it's time to just relax, take it down a notch and, de-risk. There's so much going on right now in the world, so many headwinds, so many negative things right now, and there's so few bullish ones. Just not the time to get bullish on these markets. I think we're going to have amazing, amazing opportunities. The best thing to do, in my opinion, is just wait for those opportunities, not to go looking for them. We want the market to present the opportunities to us on a silver platter, looking all beautiful and perfect and shiny. That's what we want. We don't want to go digging around looking for these opportunities. So, we'll find them. They'll come to us. They'll present themselves, and we'll take advantage of them. And that way we're not putting ourselves in a situation where we're like looking for a trade when we'd rather have the trade presented to us. So that being said, that's it for today. Appreciate all the support, all the likes, subscribes, all that stuff. Yoshi, take care as well, brother. Best stream on two. Appreciate that, my man. Thank you, brother. Everybody have a great night, and we will see you on Friday at the 11 a.m. Eastern Standard Time stream. We'll probably go from about 11 to 2 with our weekly market wrap-up, and then obviously every single Sunday and Wednesday from 8 p.m. till 10 p.m. Eastern Standard Time. Remember, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. That being said, we're going to go ahead and wrap it up there. It is Wednesday, 9:30 p.m. Eastern Standard Time on April 6, 2022. I am Crypto Trend Trader,